Welcome to The Last Trade. Welcome to the first episode of The Last Trade, a new podcast presented by Onramp. I'm going to be your host. I'm Marty Bent. And the structure of the show is going to be a weekly show dropping every Friday. I'll be hosting. I'll be joined by Jesse Myers and Michael Tanguma from Onramp, and we will have a revolving guest each week. And we are honored that Dylan LeClaire is our first guest for this show. We've got a lot to talk about today. It's going to be very macro focused and tying in Bitcoin to the macro story and how it fits in to our world. We titled this podcast The Last Trade because we're big believers in Bitcoin. We believe it is the biggest trade right now, and it is the last trade out of the fiat system. Before we jump into the topics we want to discuss today, I want to throw it up to Jesse and Michael to elaborate on why this show exists, what we're doing, and what we're trying to educate our audience on. Jesse.
Yeah. So I think there's sort of two parts here. There's why is The Last Trade a podcast that we're starting, and why does Onramp exist? So Onramp, for those who haven't heard yet, is a new Bitcoin trust. So it is a way for people who are new to Bitcoin, want to get exposure to Bitcoin, to send dollars in, get Bitcoin exposure via the Onramp Bitcoin Trust. And this trust is differentiated from previous vehicles like this in that it has best-in-class multi-party custody. And that's done through Bitcoin's native multi-signature capabilities. So 3 different institutions each hold one key to control the assets in the vault, and that greatly reduces the counterparty risk inherent in how any assets are custodied, and Bitcoin in particular. That is one of the major benefits of the Onramp Bitcoin Trust. The other major benefit is that this trust is designed in a way where customers can take in-kind redemptions and take on self-custody when they are ready without a taxable event. And that's different from how any of the other vehicles like this are set up, because anybody who withdraws from those has an instant taxable event that can really take a hit out of your Bitcoin investment that you didn't realize you were stuck in a Roach Motel where you're not allowed to leave. So that's why we built Onramp Bitcoin Trust, and we feel passionately that this is a better vehicle for customers, for people who are trying to get into Bitcoin the right way and looking for a good vehicle that sets them up for the future, and allows them to unlock the excellent properties of Bitcoin in terms of self-custody when they are ready. And our hope and aspiration is that can be a major way that people get exposure to Bitcoin and get started the right way, and so that we can encourage the proper distribution of Bitcoin over time, and empower people to take self-custody, which is how Bitcoin should be done when people are ready. So part of that is then, how do we talk about the issues of how Bitcoin fits into your portfolio, why it's an important asset for the 21st century, why we believe that this is the last trade that portfolios need to be making, should be considering making. Right now, there's $900 trillion of asset value in the world, and Bitcoin is just $500 billion of that. So that is 1/2000th of the world's value. 300 trillion is sitting in bonds. Another 300 trillion is sitting in real estate. 120 trillion is sitting in fiat money, meaning dollars and other things like that. And we believe that Bitcoin will outperform all of these categories over the coming decade. And it's the trade that everyone should be thinking about and being aware of, and understanding how it fits into their portfolio from a macro point of view. And so those are the topics that we want to cover with The Last Trade and bring to you on a weekly basis.
Yeah, I think that's an excellent recap. And just the one thing to add or to really summarize, we think about the Onramp very similar to how we thought about the format for the last trade, and that on the margins, the products have existed when you know of the GBTCs on the right side of the spectrum of somebody that's just interested in, quote unquote, digital assets or getting exposure to something like Bitcoin, but didn't necessarily know what they're buying, why they're buying it, as evident in the past 6 months with different products that have been purchased by institutional investors or high net worth individuals or just individuals. But then on the other side, the market has been taken care of on really thinking about, self custody. How do you, hold your keys in a similar way that the education and the podcast, the landscape on how to inform individuals on what is happening here with Bitcoin in a global macro sense. It's existed where you have very hardcore format focused on Bitcoin only, and then you have the general macro landscape on the education that focuses dedicated to that, but is missing that one piece of like, where does Bitcoin fit in the middle? And then it's our view that the middle is actually the largest, to Jesse's core point, total addressable market. There's quote unquote, close to $900 trillion of value that we think get repriced in this new world. And this is meant to be, a piece to share for individuals that are either learning more or have, folks in their network that they want to help get a better understanding and really meet them in the middle, whether it's on the education side or similarly with the custody model. The idea is this, for this custody model to be something that it improves upon the legacy past 10 years of Bitcoin, the hacks, the exchange insolvencies, the rehypothecation with a very transparent way, but then also adds to it by educating via Onramp and the last trade. So when individuals are ready for self-custody or the next step in their Bitcoin journey, we can help support them. We think there's been a big gap in the market for that. And we're still so early that we're excited about being able to embark on both of these.
Yeah, the core reason that the show exists is to, number one, gather with friends once a week to talk about the topics in the markets, and number two, to educate anybody out there, particularly high net worth individuals, institutions who understand that there's something here with Bitcoin and I should probably be paying attention, and we're here to help put it in your worldview in the macro landscape. And with that being said, I guess we have a list of topics that we want to talk about in this first episode, and we're going to start with real estate. Real estate is obviously a massive market and something that people use as a store of wealth. And right now we're seeing massive dislocations in the real estate market due to the Fed's interest rate policy. Fed has been raising rates for almost 2 years now. That has caused some negative externalities in real estate markets, particularly with the interest rates. Interest rates are at 7% right now, I believe, on average for new homes. And the chart we're looking at right now is the cost of buying a house versus renting in America. And as you can see, if you're watching on YouTube or on Spotify, there is a massive divergence in the cost to buy a home right now versus rent. And so to pull Dylan in here to discuss this topic, what are you like? How would you contextualize real estate versus Bitcoin at this particular point in time?
Well, yeah, I mean, I think why I get so excited about Bitcoin is I think regardless of if even if Bitcoin didn't exist, I think that the story of the 2020s from like an investment landscape perspective would be that the 60-40 portfolio is essentially cooked. The secular bond bull market in real terms is more or less over, regardless, like it's topped, it's secularly, it's peaked. And regardless, even if rates go lower and bonds and long duration assets see a bit of appreciation and purchasing power, that in real terms it's peaked, right? So everyone that's been a real estate investor over the last 40 years who thinks that they're some genius really was just piling in on leverage in a illiquid fashion, and they got rewarded tremendously for doing so. And so we're still seeing in nominal terms real estate and a lot of, maybe not on the commercial side, but residential real estate continuing to appreciate in nominal terms. But there's a certain threshold where this can no longer be sustained. I think we're maybe not there yet, but we're reaching that point, especially with interest rates at 7%. It's not the ticking time bomb that it was in 08 or 09. There's not, at least in the US, there's not as many variable rate mortgages. but that, price for any asset set at the margin, the marginal buyer, marginal seller, and just, rates going from 2-3% to 7%, that marginal buyer eventually gets exhausted real fast. So I think we're in the middle of all of that right now. And this tightening cycle, historically leads to, busts. And this is the fastest tightening cycle ever with the most amount of debt ever. So I don't really expect a happy ending here, but I don't know exactly how the dominoes will fall.
Yeah. And if you juxtapose this chart with the stat that Michael threw in the Slack group earlier this morning, which we can throw up on the screen too, which is that as of right now, 30% of your average American consumer's total income is spent on rent. So we have a chart here showing the change in the cost of rent since 2000, I believe, and the change in income. And so income's only grown 76.8% on average, while the cost of rent has grown almost double that at 134.9%. So if you compare it to the previous chart, we had that large divergence in the cost to buy a home versus the cost of rent. Right now, it seems like something's got to give, because if that were to sort of converge, the price to rent versus the price to buy, you would imagine that the average overall percentage of someone's income that's going towards rent is going to go well above 50%, which just seems untenable. And we're talking about an American economy where your average consumer is pretty tapped out here. So I guess just to riff on this, we can throw it to the quad box.
Yeah, I think that it's also interconnected. This, to me, all goes back to 1971. It really two drivers here. Going back to 1971, when we went off the gold standard, and what happened at that point in time. If you track the income, if you track wages at that point in time versus productivity, they diverge. They were lockstep together. Workers were paid more as they produced more forever until 1971, when suddenly it becomes possible to print money, to create inflation, and then there's a lag effect of dragging your heels on paying your workers more, and raising the minimum wage and whatever wage. So workers started to earn less relative to their production as the measuring stick, the dollar, shifted in its purchasing power in this new era of money printing. And then you combine that force, which has been happening since 1971, as we've been able to print money and change what a dollar means more easily. You combine that force with what has been happening since 1981, which is falling interest rates. I think it's very easy to forget that in 1981, the Fed interest rate was 15%. So a mortgage was 18%. So the cost of a home had to be pretty low, because you couldn't carry that kind of interest expense and have it be a high price home. So homes back then were 2.5 times, a home price was 2.5x the average annual income. And today it is 7 times. So, over these last 40 years, interest rates have been driven down in a pretty straight line from 15% to 0%, where they've stayed for the last 10 years. And only now are they coming up off this bottom. But we've normalized 0% interest rates. We've normalized real estate goes up in value. And that's actually because interest rates are being driven down. So when you play with the discounted cash flow valuation models for any financial assets, as interest rates go down, the value of that asset skyrockets. And that's what's been happening for real estate. And everybody thinks they've been a genius for building a real estate portfolio, but really it's been a story of falling interest rates and what that does to financial asset valuations. And so those two trends have been interrelated and have produced the moment that we're in now, where it's completely unaffordable for a millennial or Gen Z person to buy a home. And now we're starting to see 30% of your income go to rent just to try to keep your head above water. Something's got to give in that. And it's already starting to give, and that's 0% interest rates. You can't have that for a decade plus. That changes, and it's already happening. But of course, in real estate and in society, there's a major lag between financial reality and how people think about the value of certain assets, real estate being the most close to our hearts in terms of the American way of life.
Yeah, there's a lot of societal implications that we know from the past, let's call it 10 to 30 years when it comes to birth rates, home ownership, that are really fascinating. And I think while we know something has to give, the next few years to decade are going to really, I think, be exacerbated by what we just saw on both ends of it. For individuals that have to rent, 30% will continue to increase. We've seen like the defaults on car loans, credit card debt increase. And then on the other side, we know the mass exodus out of these large cities are happening. But at the same time, if you're not able to sell your home, if you're underwater, a lot of purchases, just like venture in 2021, 2022, people are underwater in their allocation when they purchase, when rates were whatever, 2-3%. And the thought that now you're stuck in that home, you cannot sell, you cannot afford the same amount of home because of the interest rate, and you're stuck in these cities that we know certain things are happening in certain coastal cities, other markets. I think there's a lot of second and third order like societal effects that will come from this over the course of the next few years.
Yeah, no, I think it's important, particularly in this higher interest rate environment, to touch on the liquidity profile of real estate compared to something like Bitcoin. As we're seeing right now, Jesse, you talked about that lagging effect. It seems like it's topping out. We had data come out earlier this week. Pending home sales in April disappointed, unchanged from March, but down 22.6% year on year. So people are finding themselves stuck in their homes. Like Michael said, rates are high, really hard to get buyers enticed to purchase homes at these prices with these rates. And so you can imagine when shit does hit the fan, when people are actually forced to sell because they have to go cover expenses somewhere else, you could have a cascading bust due to the relative illiquidity that real estate has compared to other assets like Bitcoin. And so that's one thing to keep an eye on moving forward. Dylan, anything to add to this?
Yeah, no, I just think it's interesting. A lot of people say, well, no one's going to sell because everyone's locked into 30-year mortgages at low rates. But again, like prices set at the margin. And when you see these economic cycles, we've seen this, this kind of oscillating business cycle time and time again. This time is not different. Bonds drew down 20-30% last year. They've recovered a little bit since then. But when you see wealth destructions of this size, I know the NASDAQ is trying to send to all-time highs again, which is some craziness with rates at 5 instead of 0. But when you start to see, some of the unemployment data, we're still at, the unemployment rate is still very, very low, 3.5%. But, job openings per person, total job openings, initial jobless claims, they're all starting to kind of turn in the wrong direction in terms of a robust economy. And this is literally what the Fed is attempting to do. They're telling you this. We want more people unemployed to lower inflation. And so when you start to see this, you see, there's this kind of a funny term, excess savings, like savings is some bad thing. And there's some threshold that there is too much savings in the economy. But, there's still actually some powder in Americans' savings accounts, checking accounts from the COVID stimulus. There was a massive monetary stimulus, fiscal monetary stimulus in tandem. And there's still some powder left, but those, the savings rate is very, very low. And that aggregate level of savings is drawing down. So I think we're going to enter a really interesting period where, maybe the third, fourth quarter of this year, maybe even Q1 of 2024, where unemployment starts to tick higher. You're going to have more people seeking jobs at the same time where, there's a very, very illiquid real estate market, and never mind the stock market or bond market, but where, if there's any forced sellers, there's not many people stepping in to kind of plug that gap. And I think that's where things get interesting. So, I mean, I'm not like, a real estate expert by any means, but just kind of being familiar with the history of these boom and bust cycles, history of Fed tightening cycles. That first time they cut interest rates, it's actually not even a bullish bullish interest rate cut, right? They cut when things go bad, and we're still not even there yet. So it's going to be an interesting 12 to 18 months ahead, in my opinion.
Yeah. Go ahead, Jesse.
Oh, I was just going to add that I think Dylan's completely right that this time is not different. The only thing that I see as possibly different is how quickly the Fed will have to step in to save, a 2008 scenario, but even bigger. And so I think we are probably heading towards a deflationary crunch, like Dylan was teeing up there, as the economic climate kind of snowballs a bit further in the wrong direction. But then the Fed will have to step in to save the bond market in a big way. The same sort of mechanics they've already shown they were willing to do with the BTFP program to backstop banks who are underwater. And so I think we might, in the next year or two, see them turn on the printer in the same kind of way that they did with the COVID stimulus and create $10 trillion of stimulus over the next few years, which could send real estate prices and everything else go way higher, the same way that it happened in the COVID era. Why did we have a bull market in a pandemic? It was because they printed a bunch of money and everything gets repriced because of how much money there is now. And so I kind of have this tension internally of, I think everything is looking kind of bearish, but then I think they're going to be forced to print a bunch of money, and nominally everything will rip, hard assets in particular. That means real estate, but it also especially means Bitcoin.
Yeah, no, I think an interesting topic we're touching on here is like a lot of these asset classes, particular equities, don't necessarily represent the economy. And so there's two other topics we have on the list that we want to talk about that tie into this, one of which is that Germany is now officially in a recession. They had 2 quarters of negative GDP growth, but the DAX is sitting at all-time highs. So you have that dislocation between what's actually going on in the economy and the German equities markets. And then on top of that, you had Stan Druckenmiller come out a couple weeks ago, I believe, or maybe last week, and say what he's staring at right now is not only the biggest asset bubble he's ever experienced in his life, but the biggest asset bubble he's ever studied in his life. And so whether it's real estate, equities, it seems like we have a massive bubble building up despite the Fed's interest rates.
And another thing he said as part of that was that historically in these moments, gold and silver will underperform. And yet that's something that he currently has exposure to because he thinks that when the Fed steps in, they're going to have to step in really fast. And then those assets will do well. So even though he's described the current moment as the hardest macro environment he's ever seen to forecast, and he's also, acknowledging that it looks really ugly, but he thinks that the result of this is going to be a Fed that has to inject a lot of money pretty quickly, and he's willing to sit in hard assets that historically have done poorly in a moment like this, but do well in the stimulus that follows.
Yeah, that brings up like the interesting question, like pulling Bitcoin into this now. Like just riffing on that real estate conversation. It's relatively illiquid, hard to sell your house if somebody doesn't want to buy it. You can't just exchange it willy-nilly. Where Bitcoin comes in, so many people have viewed real estate as this long-term store of value since the 70s due to the fact that the Fed and governments are injecting a bunch of liquidity into the markets. One of the safest places to go has been a hard asset like real estate, but real estate comes with cost, comes with depreciation, it comes with a lot of upkeep, and then obviously you have those interest payments on top of it. And so as we go through this massive bubble and maybe it busts and the Fed is forced to step in, do you guys see institutional investors, people with a lot of money, recognizing Bitcoin as a much preferable store of value when compared to real estate? Or maybe we don't have to answer that question, but maybe we can put forth the value prop of Bitcoin as a better store of value when compared to real estate.
Yeah, I think I like to take just kind of like the maybe like the left bell curve left side of the bell curve approach, where it's like, a lot of like the macro guys will get kind of really in the weeds and be like, it's not money printing, it's an asset swap, it's not yield curve control, it's only the Fed, valuing bonds at par value and lending against them, right? Like, well, it's like, no, it's all just balance sheet expansion or not, right? So the last, what is it, 18 months or the last 15 months of quantitative tightening from the Fed has been somewhat just offset by the Treasury general account draining to zero. And now we're at a point where they can't really kick that can. The debt limit we're there, right? And so when the debt limit gets passed, right now it's just all political theater. Let's be real. Marty, you had a great piece on this a week or two back about the debt ceiling, but they're going to have to at some point raise the debt limit like they always do. It's going up forever. And then, Yellen and the Treasury are probably going to have to go out and issue $500-600 billion, maybe $1 trillion worth of debt. And whether they go on the short end, at 5%, 5.5% rates, or they go in the long end, there's going to be some implications there. If they go on the short end, it's higher financing costs, but they probably can pull some of that capital, the $2 trillion in reverse repo. If they go on the long end, that money is going to have to flood out of equities and other kind of inferior credit instruments, right? So there's going to be somewhat of a liquidity drag there. But I think the real thing, the real value prop for Bitcoin is that we're going to see, probably we have to see, and this is kind of borrowing from the Luke Groman thesis, there's going to be negative real rates, right? Your fixed income instrument, yeah, maybe long bonds is good for a trade, right? If yields, yank lower because there's somewhat of a deflationary jolt in the economy, bonds might be a good trade. But this podcast is called The Last Trade because we're thinking about not the next 3 months, not the next 3 years, but way, way longer out. We have a really long time horizon here. So like, there's no way in hell that I'm going to buy, or I think anybody on this podcast, hopefully any of the listeners is going to buy a 30-year treasury and hold to duration, right? Because you're going to get absolutely wrecked in purchasing power terms, right? Anybody that's measuring nominal yields in the bond market over the last few years has gotten smoked, right? Even if you have gotten your interest payment, your coupon payment. So I think that's the story here. And Bitcoin kind of shines as something where there's no counterparty risk, there's no debasement risk. And like, we keep coming back to this and we keep hammering the same story because the story's still true. Like, nothing fundamentally has changed about that thesis there. And whether the macro story next week is the debt ceiling, or in 2 months it's the Fed's new word salad facility that patches up some obscure section of the banking sector. Like, we like to follow it. It's good to analyze it, but like, it's all just noise, right? Because the Fed's balance sheet is going to continue to go up. The national debt is going to continue to go up. The purchasing power of the dollar is going to continue to go down. So like, what is, as an investor listening to this, what is your long-term solution to that? Or what is your long-term insurance policy against, I don't even like to call it a hedge, right? Like, it's just like, this is happening. It's not a tail risk that the dollar debases. It's 100% certainty. So you need to think about that and how to position yourself. Otherwise, you're probably the dummy at the table. You're probably the one that's going to be, paying for that.
Yeah, and to tie your question, Marty, into what Dylan just said, this is something me and Jesse have talked about, and for the past 5 years, onboarding high net worth individuals, investors into Bitcoin, you would think there would be this there's this divergence from thinking about Bitcoin versus like real estate investors that have started to allocate to Bitcoin. They still don't see that like the trade's the same in the sense that they're scarce, but one, obviously is more scarce and has a different liquidity profile. And so to your point, like, I think over time, as information disseminates into the market, on the margins, people will decide, and what Dylan was saying, there's opportunity cost to putting the down payment versus buying the BTC, and what is the net monthly charge and the liquidity. But there's still the BlackRocks, there's still the real estate investor that owns the 10 Airbnbs. It's probably going to get wrecked. But the 100 houses versus just buying the BTC, it has all the different custody, all the different properties that are better than owning the real estate. And I thought for years that would be recognized by people that understand Bitcoin, that have heavy allocations. But for whatever reason, I haven't seen it yet in the market. And I think it's just going to be a function of time, because that 2.5 times annual earnings that Jesse referenced, that's now 7.5. That's a function of, again, the monetary premium and the loose monetary policy. It's not because it was a better investment. It's like people didn't know where to park their wealth. And then there's also the other side of it, which is just the average consumer, the average, American. Majority of their wealth is tied into their home. So yeah, to the point of like the recognition of Bitcoin versus real estate, I think on the margins it's starting to, but it'll be a 10-year plus process from an individual all the way to an institution that recognizes like, why am I buying a portfolio of 1,000 homes in Detroit, Michigan versus just buying 1,000 BTC.
Yeah, there was one of those Airbnb guys who went semi-viral this week. He's like throwing his hands in the air, like I bought all this real estate and the upkeep, like the late payments, all this stuff. It's not worth it. I can't wait to liquidate this portfolio.
It reminds me of The Big Short. It's like that on steroids, where they go and visit all the strippers that have the houses. But this is like that times 100 because everybody did it. Everybody was traveling pre-COVID. There was all the conferences. There was all the things. We live in Austin. We see it on the market, and then all of that just moves away. People do not travel as much anymore, just by definition of like the way the landscape that we all work and operate. We're all in different places right now with this pod. And now you're sitting there with all the real estate that had, 90% occupancy month over month. It's like probably, cut in half, if not less. And you own that note. It's a mess.
Well, that brings up another. We're talking about residential real estate for the first half hour of this show. We haven't even touched on commercial real estate, which when you reference those occupancy numbers, it's stunning.
Well, but before because I know Jesse wants to say something, I was talking to a friend. My previous life was at WeWork. Back in the heyday, and we were still trading at like 20 cents right now on the public markets. And he's just like, it's an absolute like mess when you think about commercial real estate. And we all know the banking crisis on that side is looming as well.
Yep. Yeah. I was just going to try to combine something that Michael said with something that Dylan said. Michael was talking about how these calculations, these portfolio allocation decisions happen on an individual basis at the margin. Marty, you also had a great piece about how Bitcoin wins at the margin. And that means people having that light switch, having that recognition of, oh, this is an asset that stands to do better than the other assets in my portfolio, so I should have some of it, and I should start increasing that allocation as I get more comfortable with that conclusion. So that's the marginal calculation happening for everyone constantly. And then what Dylan was teeing up was, this is happening to everyone. This is math. This is playing out. This is reality. So you can ignore it, and most people are ignoring it. Or you can lean into it and try to connect the dots, put out all the information on the table, and try to bring that into focus to make these little data points turn into a bigger picture about where things are headed. Because the debt ceiling, it's the debate of the moment. Are we going to raise it? We're at $31.5 trillion of national debt. Will we be allowed to take on more? We're already on track to have a $2.2 to $2.9 trillion deficit in the US this year. That means we're spending $2.2 to $2.9 trillion of money that we're not bringing in tax receipts. And that money has to come from somewhere. And it comes from issuing new debt. So we're going to raise that because we've already planned on spending a bunch of money that we don't have. So that's happening, and the math of that keeps going in one direction. We haven't had a balanced budget in 22 years. We've normalized $1 trillion+ deficits every year in this country because there's no political will or awareness of what that does on a cumulative basis and how that sends a country in good financial standing into a position of ruin. We are now at 130% debt to GDP. And 51 out of 52 times that a country has had that high of a debt to GDP ratio since 1800, they have eventually defaulted, whether that's soft default or hard default. The one exception being present day Japan, and they are in the process of soft defaulting. So that's our future. That's our fate. We are on the road to ruin specifically for the dollar. Because how do you get out of a national debt burden that great? The only way out is to print, to inflate away the debt. So you're going to print a bunch of money, and that means specifically that bonds or dollars will underperform because they have to. They have to be, their purchasing power has to be siphoned away, robbed from those holders in order to get away from this national debt burden. So, 300 trillion out of $900 trillion of value in the world is sitting in bonds, and those bonds are all priced in fiat currency, or they're all contracts for future yield paid out in fiat currency, which necessarily has to deliver negative real returns over the coming decade or two in order to get out of the national debt burden that we've accumulated over the last 40 years. So that's the math that's happening to everyone's portfolio, whether you want it to or not. And the question is, when will you be a marginal realizer of these facts? When will you put two and two together? And then what do you do as a result of that?
Yeah, in Jesse's point, it's like everybody's either upside down or starting to become upside down in their purchasing power, and that pain, how acute does it happen, and where do you find the information? But this reminds me of this title of the last trade. It's so perfect because we're thinking about who's the marginal or who's the seller. Like, you don't want to be left holding the bag, and so you buy the real estate. If you have the 10 unit portfolio or whatever, there is at some point that the recognition happens and everybody's trying to get through the door and sell the real estate or whatever the asset is. And this reminds me of something Parker Lewis, a good friend, and we'll ideally have him on the pod at some point, says like Bitcoin is the greatest asymmetry. And it's not just an asymmetry to the upside, it's an asymmetry to the downside as well, because the opportunity cost, if you still hold that real estate, what is going to happen to its purchasing power relative to other goods are going to go the other way versus if you are holding BTC. And so that's why it's so important. This is the purpose of this pod, and walking through these like just different assets and what how they've actually retained or why they have a purchasing or a value now. That I think over time, as it's recognized, and I think the pain is a big example. The example in what was it, 2020 or 2019 with Hong Kong. Matt will bring up Signal. Nobody knew what Signal was or used it, and then you have whatever happened in Hong Kong and the protests, and then at some point you needed the tool, you needed the thing, the asset that could get you out of the position that you were put in. So it's really about getting the education along with the right products out into the market. So when individuals start to make that recognition, find that piece of content that resonates, they are ready to actually get out of whatever current asset allocation they're in and start to at least think about Bitcoin as an asset that can protect them.
Yeah. Another way to explain that opportunity cost is you get into Bitcoin at the price that you deserve. And so you could deserve it now, getting in at 26.8, whatever it's at right now. Real estate's still high, or you can wait till real estate collapses. Bitcoin shot up to six figures and you get in then. Jesse, do you want to say something?
Yeah. And part of that is you buy Bitcoin at the price when you realize that you were wrong about Bitcoin, because everybody writes it off at first. It doesn't make sense. It's internet funny money. It's monopoly money for nerds. And then you live your life as if it is going to go to zero, and you keep your head in the sand for as many years as it takes for you to have some other thing happen in your life that forces you to realize that we are heading down a path that is a little bit scary. And then you start to look at the problem with a new lens of, okay, what won't be debased? What won't deliver negative real returns over the coming decade? And then you're asking questions about what is money in a sideways kind of approach, which is all it takes to get into the right line of questioning. What is going to preserve your purchasing power, and what can possibly grow your purchasing power this decade and next decade? And something that is scarce, in fact, has absolute scarcity, which has never existed before in human history, because it's never been possible to have a finite number of supply in anything in the physical world. And not only that, it has increasing scarcity, because a certain amount is created every day, week, month from Bitcoin mining, and that amount gets cut in half every 4 years. And in that next event is 11 months from now, So 11 months from now, this asset will get twice as scarce. And the same process will happen 5 years from now and 9 years from now. And what that does to the value of this asset, historically, 3 out of 3 times has been a major upwards revaluation, a price discovery to the upside for the market to figure out what is this asset worth now that it has superior store of value properties, reduced annual debasement from inflation. And then that, when you're asking those questions, then the picture becomes very clear. And it's just about getting the right line of questioning into how you're thinking about your portfolio allocation, because everybody starts from that starting point of Bitcoin is silly, it's a fad, it's tulips, it's eventually going to go to zero. And yet you're simultaneously living in the tail end of a monetary experiment that can't sustain itself because it's based in infinite debt. And you at some point have to rationalize and settle the dissonance between those two positions. And in my experience, and everybody here, their experience has been that the only thing that makes sense is that dollars will keep decreasing in purchasing power, and hard assets, gold, for example, will preserve your purchasing power over time. You will survive with gold, but you will thrive with Bitcoin.
Yeah, I think would be remiss. One note to add to that is there's, we're focusing on global macro, the asset, but there is for the, uninitiated or individuals learning or coming up the curve, that the other side of this that has importance and increasing importance is the reliance or the counterparty risk. And what Bitcoin is probably, I would say, the first, steal it from Balaji, that is it has never existed in history where somebody could actually be a billionaire until Bitcoin, that they can secure $1 billion by themselves or within some kind of individual or multi-party version. And very similar to what we've witnessed, whether it's with Silicon Valley Bank and the dollars that were held there, or if you go to all the way down to the crypto side and Ledger and finding out the past week that you can upload, or however they want to articulate that you can shard your keys. The reality is you don't have to trust a single institution or individual with your asset or your home real estate, because if they decide that they're going to allow riots and now your kids are walking past some craziness in some coastal city or whatever the case may be, it's like there's an asset here that has a different counterparty risk profile as well than traditional assets that you're used to looking at. And that is a part of why the value accrues and will continue to accrue to it.
Yeah.
I think it's also like, if someone's listening to this podcast, maybe, and I often, you'll see like critics of Bitcoin, especially when we're talking like the macro lens, it's like, well, yeah, you're talking your own book, right? Like, oh, it's just the Bitcoiners saying that, the USD is doomed and bonds are doomed. What credibility do you guys have? And it's like, no, it's not the Bitcoiners that are saying this. Like, the IMF was coming out in 2011, right? The IMF published a report. I think it was some MIT researchers who, in tandem with the IMF, released a paper called The Liquidation of Government Debt in 2011 after the Great Financial Crisis. And they said, like, there's really actually no way out of this other than we have to steal implicitly from essentially the pensioners and the people that hold government bonds. So, like, Putin's no idiot, Xi's no idiot. The people, the nations, the sovereign nations, that they can't fully abandon the dollar. It's still currently the global reserve currency, but every actor, every sovereign nation that's slowly trying to step away from sovereign debt, G7 sovereign debt, all, Eurozone sovereign debt is somewhat of a derivative of the Treasury market, right? All really sovereign debt is. But it's because they know that they're screwed. It's not just like the conspiracy theorist TM Bitcoiners that are saying this stuff. It's the guys in the know that say, no, this system is doomed, right? Here's some good stats for you, just like to contextualize the actual, debt problem. And this doesn't account for the compounding effect of high interest rates. So instead of, zero interest rate policy, it's now 5%, right? Like that compounds quickly. But just if the national debt compounds at the rate it has over the last 20 years, In 2033, the debt's going to be 57 trillion. In 2043, the debt's going to be 110 trillion. 2053, it's going to be around 200 trillion. And in 2083, I know that's a while, but it'll be $1 quadrillion, right? So, and that's, again, this is not accounting for the compounding effects of interest expense, right? Where, the interest expense is I think it's annualized at $1 trillion now. And so that's going to continue to compound, right? Because we're going to continue to run deficits. That's not accounting for off balance sheet entitlements, social spending. Which is already, $100 trillion, $150 trillion figure.
180.
Yeah. So like these are not just like Bitcoiners that are saying this. And I think the last thing that I would add is I think the big realization, maybe, the thing that we want to drive home the most on this podcast is for the macro people that maybe do get it, or the people in general in the investing world that, dismiss Bitcoin or think it's a nice speculation. It's beta on the NASDAQ, I'll have it as a trade. I think the big realization when you do a deep study, a deep dive into Bitcoin, as well as the macro system, and come to the conclusion that there is no long-term solution. And it's just a bunch of people kind of trying to keep this system duct taped together and kick the can down the road. It's, you can't insulate yourself from Bitcoin's ascension. If we're right, which the last 12 years or 14 years have continued to reiterate the fact that Bitcoiners directionally are correct about where the world is headed, you can't insulate yourself from its rise, from its ascension, from it bootstrapping as a predominant monetary asset around the world. And so that may sound far-fetched, that may sound super outrageous or hyperbolic to someone that's saying this is just digital casinos, right? Bitcoin is just this crypto thing that, the internet anons trade. But anybody that's saying that hasn't done the work. And as a result, if you don't take the time, if you don't actually dig into what this is, you cannot insulate yourself from it.
Yeah. And piggybacking on something you said earlier, like the IMF and MIT wrote that piece in 2011 saying the liquidation of this government debt is not going to be pretty. I mean, we have another signal of that this year where the Treasury came out and said, hey, we're going to open up this buyback program in 2024. So they're forecasting a lack of demand for treasuries themselves. And so they're signaling like, hey, we will buy them to be a buyer of last resort in this particular market.
Which is Japanification. That is what Japan has had to start doing 10 years ago. And luckily they had the support of the G7 sort of propping them up for the last decade. So it's been kind of a slow moving, circling the drain, but we won't have that luxury because nobody can backstop us. So once we cross that Rubicon, we already crossed the Rubicon in 2008 when we established the precedent of bailing out too big to fail banks, in my opinion. So it's just a matter of time now, and that matter of time is going to be this decade, or it might bleed into the next decade. But this is why it's the last trade, because currently Bitcoin is a tiny little blueberry sitting out there on the global asset value landscape. I think that the chart that I made was
let's pull up that chart, Logan, just to contextualize this visually for people out there. Not this one. It's the chart of Bitcoin's relative market. There it is.
Yeah. So I put this together to take stock of where is the value in the global asset landscape. And for people who can't see, there are visual buckets here for real estate, bonds, money, equities, art, gold, Bitcoin, and a little collectibles bucket as well. They all total up to $900 trillion of total asset value just stored in these different buckets, right? And everybody, and this is the product of everybody's bottom up individual calculations of how they want to allocate their portfolio. Because what is your portfolio? It's how you're storing your wealth. It's how you're investing your wealth. But that's really storing your wealth, because you know that inflation will eat away your wealth. So you can't just put it under a mattress and sit on it. You have to invest it in the way that the world works now. And Bitcoin is that tiny little $400-500 billion blueberry in an ocean of value, and everything else in that ocean of value, or at least half of that ocean of value, are assets that are contracts for future dollars or future fiat money. In a climate where we know that there's going to be massive debasement, so those contracts for future money will deliver negative real returns. And Bitcoin is the only thing that has this increasing scarcity mechanic built into it that will reliably deliver value appreciation every 4 years. It's volatile, it's uncertain, but that appears to be the mechanics. And then it's just a function of the marginal individual waking up to the reality of that math. I think that's what Dylan keeps hammering here. This is all math. This is what Greg Foss talks about. There's no way out of math. We have to pay interest expense on our national debt. For the last 10 years, that interest rate has been 0%. Now it's 5%. And so we're quickly, and 5% on $31 trillion of national debt is $1.5 trillion per year, purely in interest expense. That doesn't buy you anything. And that's coming online now when we haven't had that for the last 10 years. And our political arena has sort of gotten accustomed to there being no cost to racking up additional national debt. And now that bill is starting to creep in. It doesn't immediately show up. These contracts are priced over time, but they roll over at the current rate whenever they do come due. And about half of them, I don't remember the exact numbers, but in a matter of a couple of years, we will be paying $1.5 trillion in interest expense at the current rates, which we weren't paying a year ago at all. So, that's just one piece of how the math works here. And it all points to everything getting wrecked while Bitcoin's mechanics keep causing it to appreciate in value because of its increasing scarcity.
Yeah. And
one thing.
Go ahead, Michael.
I was going to say, to add, like Dylan said something that's really fascinating and interesting that I don't know if you guys have thought about the past few months as like the trade on the bookends are really the same when you think about an individual or on the geopolitical landscape in like Russia, for example. Like they are an net exporter of, proof of work. Oil, we're an individual net exporter of whatever our time is, whatever we produce. And if we lose purchasing power, we're insolvent. Similar as a country, they can't, export oil, take in dollars, and then those reduce in value. And then they have to feed their, for grain or whatever they need for Russian citizens. And so they're making the same trade as like trading oil for hard assets. And we're making a very similar trade as individuals for trading whatever we're doing for hard assets, Bitcoin. Going back to the Paul Tudor Jones quote, we're picking the fastest horse, but a similar trade, hard asset. But the crazy thing is, and this is like to take us back from, okay, we're not the crazy Bitcoiners, we're not even talking about Bitcoin. Like they're attempting to make Bitcoin over there right now. Like they're literally trying to set up a like system outside of the dollar that has different commodity hard, whether it's, gold, silver, whatever they're going to put underlying this basket of currencies so they can transfer for next. That's going to have all the crazy counterparty risk and all the things. And we're just going to have 10 years of them trying to go into the system while Bitcoin's being built in parallel. And then one day, 10 years from now, whatever the time is in each country, we're starting to already see countries do this where they'll mine or they'll start accumulating on their balance sheet because they're just going to realize it's like it was Bitcoin the whole time. This was the asset. Yep. So it's interesting to see. Like they're already doing it. They're not saying it's Bitcoin. Well, they're probably in Russia. Probably is accumulating Bitcoin, but just fascinating to watch. Yep.
Russia definitely is. They're mining Bitcoin. They've essentially nationalized a lot of the American miners that were hosting in Russia when the sanctions came in. The Russian government essentially confiscated those ASICs, kept them turned on, and who knows where they're actually accumulating those sats on their national balance sheet. But I think it's pretty obvious, and it is a fact that Russia is mining and accumulating Bitcoin. But on top of that, like I wanted to add, like we're focusing on the asset part of Bitcoin. There will only ever be 21 million. It's the scarcest asset on the planet. Comes with significantly reduced counterparty risk, but another thing to really drive the value prop of Bitcoin home is that it runs on this peer-to-peer network, this layered system that supercharges the digital age. Like we have native payments in the digital age that are run via this extremely scarce asset for the digital world. And so we can sit here and talk about the fact that you can pour your wealth into X out of the 21 million that will ever exist. But on top of that, you get the value add of that running on a layered peer-to-peer network that really makes trade more fluid. So in Michael's example, where you have the BRICS countries of the world trying to create these commodity baskets to back their currency, still at the end of the day, you have the counterparty risk, you have the physical commodities that need to be held in vaults. You need to be assured that they're the actual commodities that they're portrayed to be. And then comes with a lot of added cost on that. And then if you ever need to transfer to settle internationally, obviously you have to move that. It's a lot of weight, it's a lot of costs, it's a lot of fuel, it's a lot of protection. Bitcoin, completely different. You send it over the internet, over this peer-to-peer network. And so not only do you have the value of the scarcest thing we've ever come into contact with as a species, you have the added benefit of being able to send it over the internet instantly.
Yeah, it's the money of enemies. I always anchor to a quote that never was picked up. And shout out to, because we haven't heard from him in a while, but Murad is Bitcoin at the end of the day, when it's all said and done, will be geopolitical, monetary, nuclear weapons. Like if you need to settle on, whatever the tanker of oil and gas or whatever's being shipped, well, what are you going to do that doesn't have the counterparty risk profile like that you just alluded to? Because we've already seen what happens on net settlement of gold trade and how it centralizes. But we're going to redo it for the next 10 years, and then we're all going to go back and be like, oh, it was Bitcoin the whole time.
Yeah, Bitcoin is this incredible convergence of mega trends, because we talked about, we spend most of the time talking about the great monetary inflation that we're embarking on now. But then there's a couple other mega trends here too of commodities. And I think that's what the BRICS nations are landing on is in an era of the great monetary inflation, you want to own commodities. And so, yeah, gold and oil, try to set up your value system based on that. And for that matter, in 1980, the total value of all the gold in the world was 2.5 trillion, and the total value of all the equities, all the stock markets in the world was 2.5 trillion. Fast forward to today, total value of all the gold in the world is 10 to 12 trillion. Total value of all the equities in the world is 120 trillion. So over the last 40 years in this era of decreasing interest rates, financial assets, equities in particular here, outperformed commodities by 10x. And now all those conditions are reversing. So the BRICS nations are smart to be recognizing that, seeing, okay, the era of financial asset bull market is over. And now it's time for a reversion to the mean, and we're going to bet on commodities. They're right. They just haven't gotten that extra step to recognize that Bitcoin is the perfect commodity. So there's that as another mega trend. And then there's finally this last and possibly the biggest mega trend of free and open source software is eating the world. And we saw that with the internet. The Internet of Information is built on TCP/IP, just a protocol for how information is exchanged and represented to create the internet. And now we have the free and open source protocol for value. And that is how the world is digitizing value with Bitcoin. So now we have the set of rules for how to store and transmit and represent value in the digital realm. And that's Bitcoin. And those free and open source systems always win. That's what software eating the world is. And that's, probably the biggest mega trend playing out right now.
Jesse, to contextualize like what you said, I think you nailed it there, like comparing golds. Like, because a lot of people will say, yeah, I mean, gold protected your purchasing power, right? Especially when you talk to someone that's a gold proponent or a gold bug or, a gold salesman. They'll say like, yeah, well, it's a fine man's suit, right? It's done a fine job. It's gonna outperform really, really well. But contrasting it to the growth in equities, to the growth in debt markets is really, really important, right? Because at one point, gold was the denominator for all of the world's wealth, right? At one point, it was a measuring stick. And then, obviously in 71, they defaulted. And what we saw was essentially debt markets became quasi-money, right? Quasi-money supply was the debt markets. So sovereign debt became a sort of money-like substitute. And then, as rates continue to hammer lower and lower and lower, equities in a way through passive indexation, 401ks, pensions have become quasi money like, right? Especially in a zero interest rate cost of capital world post great financial crisis. Bonds, there wasn't really much juice left to squeeze. There wasn't much yield. So, okay, we're gonna plow into equities, right? No one even makes an economic calculation or not whether to buy a business anymore. Just plow it into the U.S. stock market, plow it into the NASDAQ, and get your return, right? Like that's almost the money now. And now we're seeing it right with commodities, where they're trying to monetize in a way commodities, and not to use the commodities, but like, oh, we're going to make a currency basket based on oil or based on energy or based on this hard commodity. But the reality is all these commodities will be reduced to their marginal production cost. We'll produce more commodities, right? To an extent, gold may be the best because it's the hardest to produce. It's atomically scarce, but yeah, we have a absolutely scarce synthetic commodity. And so the bet is just that its marginal production cost, which is only going up forever. If you understand hash rate, if you understand the incentives to mine Bitcoin, and you understand the difficulty adjustment, it's just, it's the best. It's explicitly the best, and there's not really any debate there. The debate is just, when there is a debate, it's because that person on the other side just doesn't understand what they're debating.
Yeah. And it's easy to it's, you have sympathy for those folks because this is new. This is new to the human experience. There's no comparison to anything. You can create your analogies, and I try. I write about the metaphors that I think help explain how Bitcoin is a digital frontier, whether that's talking about land in the American West or comparing it to the development of the internet. But really, there's no way to compare what's happening with Bitcoin to all of human history. And we've been using hard money in some capacity for 70,000 years. It is how we as a species emerged as the dominant Homo sapiens subspecies over Neanderthals. It's because of our use of money. Neanderthals didn't use money, and that allowed for 10 times greater population density. And so appreciating scarce, hard money is ingrained in our DNA, but that has only existed in the physical world, the tangible world. That's seashells. That's gold coins. That is what has made sense to us as a species. And now you have to abstract that to understand that it's about scarcity itself and unforgeable costliness. And that is removed from the physical token, the item that you have. Your brain has learned to covet the trinkets because seashells were money. And now you have to go beyond your DNA, which was this great operating system for thriving in a world of hard money, and understand that it's about the actual scarcity itself and not just the shiny thing in your hand.
Yeah, I think one of the things that we'll expand on as this podcast, week over week is like not only the asset, but just like how do you navigate this new world? Because a lot of the stuff right now, especially we're talking about, the past 3 months and heading into the next, let's call it 3 to 12, 18 months is, rising interest rates, deflationary. That means a lot of people losing jobs, a lot of businesses. There's going to be a lot of pain, but at the same time, everybody's starting to think, well, we've seen depreciating or lower amount of venture capital raise, amount of exits. The reality is we should all start getting used to that world because the cost of capital is going to only get greater as more and more people recognize Bitcoin as an asset, because then you have to think about the opportunity cost to give up that Bitcoin. And so it's really thinking, what are you doing? What are you building? What are you contributing to actually have a positive cash flow in this current environment that is been so far removed from individuals, from investors, from startups in this space, or just in general, because of loose monetary policy and zero interest rate environment, that it's just growth, and we'll get there. And we're realizing that was all BS. And we're going to see 80% of these companies that have started the past X number of years, because it's just corrupted at the foundation when you're not concerned about building a solid foundation of like revenue positive and what does that look like. So I just think that's a key point that we'll talk about more. But when Dylan brings up that we just gave it to the 401k or the mutual fund or the bond, and we're just like there, it's like that's all over now. Like people are gonna have to think, and they're gonna have to realize like, how do you actually protect their wealth? And that is Bitcoin. But then independent of Bitcoin, it's just like, well, what are you producing that either produces Bitcoin on it, as a business, or you would take those cash flow and be able to, store it in a form of money that increases in purchasing power. So yeah, it's just a very interesting landscape because there's a lot of negative right now. It's also, we should get used to it because that's the world we're heading in. It's going to change. We have to change how we think about what are productive assets, or how do we use our time to create productivity in the new world.
Yeah, and I mean, that's not necessarily a bad thing. There may be some short to medium term pain, but in the long run, like you said, Michael, bringing back opportunity cost to the economy will be extremely beneficial. And that is what the Fed and the federal government have taken away from us, is the ability to properly price opportunity costs in the market via a natural forming interest rate. Their ability to manipulate and set the interest rate completely corrupts true opportunity cost and the true cost of allocating capital throughout the economy. So yes, we are at the beginning of this paradigm shift where you're going to have to check your priors and adjust accordingly moving forward. And it will be a bit turbulent and a bit unnerving for many people. But in the long run, this is massively beneficial for society, for an actual productive economy that is producing goods and services that people actually want and need, and will provide a better quality of life over time.
Yeah, we've been talking about the macroeconomic house fire around us today, but I think this is what Michael's talking about, is exactly what the value of the last trade will be, in your podcast lineup, your rotation for all the listeners out there. Of we're going to be able to dig into what are the exciting businesses who are generating Bitcoin cash flow. Why do they have an edge over zombie companies who believe that their hurdle rate is 3% when really it should be 23%, because that's what Bitcoin's returning this 4-year cycle, on an annualized basis. And nobody's really talking about that, so that's what I'm excited to dig into with you guys and Dylan when we have him, and other guests when we have, our whole rotation. And I think that there's a ton to dig into about the business reality of the present and future on a Bitcoin standard, as we watch the house fire around us turn into an inferno in the fiat world.
Yeah. Speaking of the house fire, we do have more things on the list. I don't think we're going to be able to hit everything, but one thing that you mentioned earlier, Dylan, that we do have is the sort of predicament the Treasury is going to be put in when we hit the debt ceiling and they're forced to raise it. What do they do? Do they allocate to the short end or long end of the curve? And you posted something in your weekly newsletter highlighting the 6-month US T-bill, which has hit 5.361%, which is the highest it's been since around 2001, 2002. What is that signaling to markets right now?
Yeah, I mean, I think that the short end of the curve is essentially just a blended average of the expected Fed funds rate. We saw, I think it was yesterday or earlier this week, we saw UK inflation come in super hot, core inflation come in super hot. The inflation is transitory camp. Obviously they got blown out of the water, but I think it's still somewhat entrenched, right? We had 30 years of disinflation because of all the factors like globalization, a unipolar world order, deflationary debt dynamics. I think that genie is somewhat out of the bottle. So even if on a year over year basis, inflation is coming down, rates are higher. And I think one of the funny things, not funny things, but maybe sad things, and we shouldn't really expect any competence out of bureaucratic government officials and branches, but while inflation or while long end 30-year, 20-year yields for debt for Treasury securities was at 1%, 120 basis points, 150 basis points, the government was actually just punting short end bills because the yields were 20 basis points, 0%. They're saying, oh, why not? why not, instead of taking, 30 years of debt out at 1% to finance our operations, let's just do 1%, or 1 year, 2 years, because it's cheaper, right? And now they're faced with the task of refinancing $500-600 billion of debt. I think 50% of debt matures in the next few years, and a laughably small percent is actually due longer than 10 years away. They're gonna have to roll it over at a much higher cost. And so, the debt markets will certainly react to that if they try to go to the longer end, because yields are lower now because the yield curve is inverted. So they're in a pickle. There's about $2 trillion of money parked in that reverse repo facility. So if they issue short end bills at 5%, well, they'll have to finance at that cost, but they can access that liquidity. And if they want to get a little bit of a lower coupon, then they're going to have to pull it out of debt markets on the long end, and it's going to impact the stock market valuations, and it's going to impact credit markets. And I think that could get a little bit ugly, especially if the timeline, somewhat lines up with unemployment rising and consumer savings really being tapped out.
Yeah. Be aware. We're about an hour and 10 minutes in. This is the first rip. How do you guys think? I mean, I do have one more topic I want to talk about, but let's do a little game tape, introspective. We did a lot of digging into Bitcoin fundamentals. We're probably not going to do that week in and week out. We'll probably touch and weave it in and out. But I think this has been a very good rip so far. The first of the last trade.
Yeah, I can't help getting into the fundamentals, especially on an inaugural rip like this, because I think that paints everything. Like I talked about earlier, everybody is in this position of they have to pull together the little data points in order to start to form a picture, and then zoom out enough to make that picture make sense about what's happening in the world and what they need to do with their portfolios in order to adjust to that changing world. And nobody's doing it, is the reality of it, because we're all living our lives. We're all doing our jobs, running businesses, paying attention to our families, paying attention to our golf game, not necessarily focused on how am I about to get screwed by my portfolio allocations, and how should I be proactively changing where my money is pointed in order to survive what could be a turbulent 10 years when we haven't had a truly turbulent 10 years in 80 years. Nobody's thinking about it, and it's going to blindside most people as a result of that. So I end up getting on my soapbox about that big picture view very quickly. But I am excited about this format for talking about all things Bitcoin as it relates to business and not just portfolio allocation, but what are people doing in Bitcoin? How are businesses adjusting to and taking advantage of the properties of Bitcoin? And what does it mean from a business sense to adjust to this new Bitcoin standard? There's so much to talk about. Today just happened to be the soapbox of the big picture.
No,
I think
you got to get back to basics. You got to paint the picture.
Yeah, I think we'll naturally, because of Bitcoin's so multidisciplinary, we'll continue to weave week after week of basics, that how they tie in to the new world, and then where the world's headed, or our thoughts on it. What Jesse mentioned anchors back to, I think about year over year, the signal, the fidelity gets tighter as this kind of mediums increase with the conversation, the writings, and I anchor back to early at Unchained, we did the consultations, and there was a common theme. It was did hundreds of them, where everybody pointed back, or not everybody, but I would say 80 to 90% of individuals said during the lockdowns of COVID were the point. And there was the trillions printed, but more than that, it was that we were just basically locked in a box. And so they had time to listen and think and read, and everybody's stuck on the hamster wheel. And so ideally this hour long, however long it goes weekly, can provide a lot of that information that would have taken, weeks, if not months to come together and distill there. And then as far as where it goes, I'm definitely excited about talking about a lot of stuff we talk about behind closed doors, but bringing it to a public forum in the sense of where's the puck going? What are we seeing? What are the trends? We didn't get to jump into it. Maybe next week. Wolf did their accelerator. There's some interesting projects there. What does the landscape mean for, new Bitcoin native companies, and then, incumbents that are going to adopt Bitcoin and stay relevant. So a lot of that will be interesting along with the global macro environment.
Yeah. And to both your points, Matt Odell wrote a great piece, I believe it was last week or the week before, but we really shouldn't have to worry about all these portfolio allocations just to preserve our purchasing power throughout time. You should be able to focus on your golf game. You should be able to focus on your job and your family and just living your life. You shouldn't have to think about portfolio construction just to save your wealth so that you can someday retire. It is insane that we live in a world where that is completely necessary just to be able to have some integrity at the end of your life. It's pretty insane, and that's what Bitcoin fixes. It is a vehicle that allows you to simply work hard, make an earning, be productive, save the excess of what you don't spend in an asset that will respect your purchasing power over time.
Marty, I got a good quote here. I posted this on Twitter, I think last week. It's from Jim Grant. It says, if baseball umpires were on the front page of the sports section every week, you'd know something was desperately wrong with the game. And that's investing, right? It's like, what did Christine Lagarde say in what tone? What did Jerome Powell? Jerome Powell blinked the wrong way and wore a red tie. It's really hawkish news presser. And so, and again, I'm being a little hypocritical because some of the macro analysis I put out is on what the Fed speakers are saying and what, the FOMC probabilities are saying about the state of the tightening cycle or, whatever it may be. Right. Cause the macro does matter. But right. If you the reason I think that a lot of people on the younger end of the spectrum, myself included, why Bitcoin clicked for me right away as I studied the Keynesian system and Bitcoin, not right away, but with a little bit of work, was because objectively it just makes much more sense. Programmatic monetary policy that no one can change and is open source. Duh. That makes sense. What doesn't really make sense to me is if learning the two system from scratch is this 60-year-old private equity bureaucrat lawyer that comes out and makes monetary policy decisions for 7 billion people. That doesn't make too much sense. So obviously, we're all in the system. A lot of the investing world has grown up in the system and has never known anything other than it. But if you're just from a first principles standpoint, and not that this is all about merit and what's better and how the world should be, right? Because a lot of Bitcoiners wax poetic about that, but we can't change that just by wanting something. It's my opinion, but the Bitcoiners are putting their money where their mouth is, right? It's no, this is the world. This is what I want it to be. This is where I think the world is going. And I'm not just opining about it. I'm actually putting my blood, sweat, and tears and the fruits of my labor. I'm actually pouring it into this thing I believe in. So that's where it's the whole, do you want to be Occupy Wall Street or do you want to be Bitcoin? Do you want to, go protest in the street and make cute signs? Or do you want to actually allocate capital to change the world in your vision? And I think that's why Bitcoin is so powerful.
Yeah, and there's an economic reality at the end of the day. We're either right or wrong, and it's very Darwinistic in the sense you quoted it earlier. So you can't insulate yourself from a money that's harder than yours, and so eventually somebody pays for it. Either you have a money that increases purchasing power and you end up on the other side of it, or you don't. So yeah, there's a lot of narrative going on right now with the crazy guys in the Bitcoin side, but the reality is it's just you either hold one or the other. And over the past, 12, 14 years, whatever the number is, if you're holding it and you're securing it, because that's the hard part, right? The easy part is to buy it. The hard part is to hold it through the volatility, through the exchange hacks. And that's some of the things we want to support, whether it's here with the pod or Onramp. But you can do those two things and you're setting yourself, your family up for a better economic reality than what's currently happening across the world.
Yeah.
Marty, to your point earlier of, not needing to focus on, we shouldn't have to focus on portfolio allocation in order to live our lives. Traveling from Miami back here to LA from the Bitcoin conference, I was in the airport and one of those, conveyor belt walkways helped me get somewhere a lot faster. And I was thinking about how when it comes to our money and how we're living our lives, when you're on an inflationary monetary unit, you have to work harder to keep where you know, in the same place, because your conveyor belt that you're standing on is actually moving against you. So you're running to make a little bit of headway because your money buys you less and less over time. It is acting against you. And then the flip side of that is being on a conveyor belt going in the same direction as you, where your money grows in purchasing power over time. It helps you get where you're trying to go faster, get to a comfortable retirement faster. And so your efforts of moving in one direction are aligned with the money that's helping you move in that direction faster. And we've normalized over the last 50 years being on a treadmill that's going against you.
It's getting faster.
And it's getting faster. And we're all running, trying to make a little bit of headway in real terms, running our heads off in nominal terms. And we don't have to be on that treadmill. You can switch to the other treadmill, the deflationary treadmill, that is going in the same direction as you.
That reminds me of Marty's, it was a tweet thread, but then also in the newsletter, maybe we linked to in the show notes, of the shrinkflation tweet.
Oh, yeah.
Like, it's just like everything you buy is just progressively worse, no matter what it is, whether it's the home or just the package of Twinkies or whatever.
Yeah, I mean, shrinkflation is a somewhat visible form of inflation, but then there's other things. Like there's some things out there in the economy, no matter how much you pay, you can't get anymore, just because the cost of capital has been jacked up so high. Nobody's incentivized to produce it and bring it to market, and so that's another negative effect of consistent and persistent inflation over time, is that eventually, like, not only are your goods raising in price and falling in quality and quantity, some goods are just falling out of the market because nobody's incentivized to bring them to market anymore because it's not worth it.
And that's the story of craftsmanship in the U.S. from the end of the American Revolution to the beginning of central banking in, was it 1913? 150 years of the gold standard and economic stability and rule of law, which culminated in the Gilded Age. And if you walk around in any big city and you look at all the most impressive pieces of architecture, or you go into the foyers and look around at glorious craftsmanship and all the woodworking details and stained glass windows, all of that was constructed at the culmination of 150 years of deflationary forces, because we were on a gold standard. And craftsmen had to improve the quality of their work in order to keep their prices flat. You had to get more for the same amount of money, generation after generation after generation, for 150 years, to a point where the quality of work that you could get was incredible. And that's all gone now because those forces don't exist anymore. It's hard to find craftsmen who can deliver great quality without an arm and a leg. And it's just like it's a forgotten piece of what we had and what we can and will go back to, just by embracing the money that is working with you rather than against you.
Yeah. I think that's a beautiful note to end it on for the first of the last trade. Gentlemen, it's been a pleasure. Dylan, thank you for being our first guest.
Thanks for having me on, guys. It's a great team. I think it was a great podcast, great overview to start. Covered a lot of ground, but yeah, real good primer for those initiated or not onto what all this means for the future.
Yeah, Jesse, Michael, want to send it off with anything?
Yeah, if people enjoyed Dylan's analysis here, Dylan has started doing a weekly news digest for Onramp, and that is available for free to anyone who subscribes to the Onramp newsletter. And you can find that at onrampbitcoin.com/newsletter, and sign up and get Dylan's insights on a weekly basis about the biggest things to know about going on in the macro and Bitcoin markets. You also get a weekly piece from me, ranging from Bitcoin and macro analysis to Bitcoin educational content, whatever fits the moment best that I'll write about on a weekly basis as well. So go sign up for that if you enjoyed the content here, and check out onrampbitcoin.com in general to see to learn a little bit more about the Onramp Bitcoin Trust, the product we've built, and how it could fit into either how you're approaching your Bitcoin allocation and custody, or for a lot of you who are listening to Bitcoin podcasts, you've already done this, but it could matter for somebody in your world, someone in your network, whether that's a friend or family or an institution you work for.
Yep. Yeah, we want to be a resource, whether it's on the product side and supporting on a better form of custody, the trust, and getting exposure. But then ultimately, we're the biggest bridge we see and is really supporting via this pod. The content we put out, we're discussing with other really prominent content producers to be able to leverage some of the material to help in the education, as well as us. We're Bitcoiners, so if you email us, if you send us a note that there was something that came up that you want more information on or would like us to go further or jump on a call, we're happy to support. There's a lot of stuff we're working on in the background to bring to the market that we think there's a big gap on the Bitcoin only focus with this area of the market and being able to help educate. And so we're really going to be focusing on that for the rest of this year and heading into 2024. So anything that you have, thoughts, feedback, questions, please reach out. Whether you're a client or not, we're going to be in the market educating for now until, as long as we exist.
Well, gentlemen, it was a pleasure. The first rip is in the books. We'll see you guys next week for the second rip. Enjoy it.
Awesome. Thanks, guys.